Good afternoon. Welcome to the Money Matters, the week ending September 26, 2025, almost the end of the third quarter. So, today I'm going to talk a little bit about interest rates. We've recently started, well, we did have an interest rate cut last week and then a few questions around it. So, I want to dig in. So, this is from our friends at YChart. The whole thing's attached if you're so inclined to go through it. But just kind of take you through some context going back. In 2022, we were pretty much coming out of COVID, and we were keeping rates very, very low for a while to stimulate the economy and catch up and get back. And then you can see we sort of had this almost unprecedented rate heights. This is indicative of the federal funds rate, and it went from 0.25 all the way up to the high July of 2023. It was at 5.5. So not everything is based on the federal funds rate, but generally they tend to follow, right? So the cost to borrow money goes up on the downside. On the plus side, things like checking and savings and CDs that we're paying next to nothing, you could get 4 or 5, maybe even better percent. And so that was kind of the cycle we were in for a while. Then we've got into this next cycle, which is essentially started towards the end of last year, where now, hey, inflation maybe not so bad anymore, and we don't want the economy to go the other way. So they start to cut rates. And so we've seen a couple rate cuts now. This last week, 25 basis points. They generally are going to do a really low cut because it's just, kind of touching it a little bit at a time. So kind of you can see how that's gone. They're trying obviously to manage unemployment. That's a big one. Doesn't always work, and there's a lot of lag in here, and different economists will have different views. But essentially, the Fed is gonna use rates to try to get the economy to cooperate. And as of recently, it's done a pretty darn good job, far better than they've done in the past. Wherever you align politically. So now, as we sit here in 2025. We just had this rate cut now, so the federal funds rate is at 4.25. Now, this page here just talks a little bit about how things react to cuts. Generally, stocks like a rate cut. It's incentivized in more investing. Bonds benefit in a sense that the yield or the interest they earn tends to go down, but prices tend to go up. So if you own bonds, their prices tends to go up. Again, on the downside, your rates, and you've seen this, and God bless those banks and credit unions, they'll start cutting rates and they won't tell you. You'll just look at your statement one day and go, oh, gee, I was getting 5 and now I'm getting 2. So you want to pay attention to your money markets and your cash, and really be looking for deals, because those are going to start getting cut if they haven't already. Some of these good CD rates are going to start to fade, and just pay attention to what you're getting. On the plus side, borrowing costs generally will start to fall, although it is not entirely based on federal funds rates. So if we kind of look out here, I'm gonna skip this cost of borrowing, and now this is probably small for a lot of you to see. I'll try to make it a little bigger here, but we can kind of see here. We'll go with, most people do a 30-year mortgage, so 2000, and we got. I mean, the sweet spot was like 2020, 2021. People had got 30-year loans at 2.25, 2.5%. It was awesome. And then they shot up into the 7.5. 30-year right now is sitting around 6.3. A 15-year is about 5.5. And I mention that because there may be a few of you who might, if you're in a 30-year note or even a 15-year note on your mortgage, and you're paying north of 6.5%, you may want to take a look. Talk to your bank or your lender. It may not be the perfect time, but if you can save a half point or a point, maybe worth considering. Okay, because it's better than they were. So with that, over time, as the story goes, markets tend to perform in any scenario, whether we're cutting rates or raising rates. The long term is good. Could be some short term volatility. And that is, really the story of interest rates. Again, you can read this through. There's much, much more detail in here, and it shows you all the rates and different things. But in short, it is sort of a tool that the Fed uses to try to stimulate and grow, or pull back and tame the economy, depending on how things are. As always, thanks for watching. Appreciate your business and your trust. We're here for you, your family, and your friends.